Greetings. This is market wisdom for traders, for stock traders, forex, Bitcoin, cryptocurrency, options, futures, commodities, equities, ETFs, and all chart-related trading. You are advised to subscribe, share, make comments. So you can contact us for account management. You can contact us for training, online or physical training from any part of the world. You can call us or WhatsApp us on 080 375 97085. Investors often make the mistake of equating manager performance in a given year with manager skill. In some instances, more skilled managers will outperform because they refuse to participate in market bubbles. In fact, during market bubbles, the best performers are often the most imprudent rather than the most skilled managers. I adhere to a discipline of living on only 1/3 of my income and investing the remainder. At the lower bound, we would be 130% long and 20% short. At the midpoint, we would be 100% long and 50% short. We are 50% net long at the midpoint rather than neutral because of the long-term secular uptrend in stock prices. At the upper bound, we would be 90% short and 20% long, or 70% net short. Our net exposure will increase as the market goes down and decrease as the market goes up. For every 1% the portfolio loss, I reduce the exposure by 2%. If you didn't short the stock when it was 80, psychologically, it is very difficult to sell it when it is 50. As long as monthly loss is less than 7%, we are still in a normal range. If a loss exceeds 7%, it indicates that something is wrong. If I can figure out what is wrong, then I might not change anything. If I can't figure out what is wrong, then I have to reduce the exposure. On the long side, there is a limit to how low prices can go. But on the short side, the risk is open-ended. When your investors look around and you are losing money while everyone else is making money, they are much more likely to pull their investments. Just because you made money doesn't mean you were right. And just because you lost money doesn't mean you were wrong. It is all a matter of probabilities. If you take a bet that has an 80% probability of winning and you lose, it doesn't mean it was a wrong choice. A big mistake investors make is that they judge whether a decision was right based solely on the outcome. There's a lot of randomness in the outcome. The same set of conditions can lead to different outcomes. Whether a trading decision was right or wrong is not a matter of whether you won or lost, but rather whether you would make the same decision all over again if faced with the same facts. assuming you have a profitable process. There is no place to hide in a liquidity sell-off. People sell everything because they have to, not because they want to. The reverse rarely happens on the upside. People don't run out and buy everything. Shorts are easier to find than longs. It is easier to spot a broken company than a good company. It is easier to identify bad management than good management. The general principle is that we look for future revenue generation that can be reasonably anticipated, but that is not reflected by the current market price. This idea is probably the single most important concept in our stock selection process. Vary exposure based on opportunity. There is no way of knowing a priori which individual trade is likely to be a winner. Traders need to accept that a certain percentage of good trades will lose money. This brings us to the end of this episode 33 of Market Wisdom for Traders. Remember to subscribe and to share with other groups so as to improve this broadcast.